Hey, hello investors and future investors. Welcome to the channel. For today's video, I'm going to be doing a deep dive on the PMCC or poor man's covered call. I'm going to show you how you could use this one option strategy on one stock and you could get 100% returns in just 1 year. Now, if you're new to option trading, this is definitely the video you want to pay attention to, and most definitely the option strategy that you want to practice in your portfolio. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to show you how you could use this option strategy in order to grow your portfolio consistently over time. That being said, let's go ahead and get down and dirty with options. Now, before we go ahead and get into the option chain, we're going to start off this video by going to the Robinhood Advanced feature, and you could get into that by right here. Now, this is the Robinhood Advanced feature, and now we're going to go out 1 year. To the top, you're going to see 1Y depicting 1 year. Now, what I want to bring your attention to is the 200-day moving average, as you can see here to the left, MA200. And that's going to be depicted by this blue line right here. So we're going to follow this blue line, and immediately, as we can see here, the Spider ETF is trading below its 200-day moving average. So that right there is a very good buy sign. But if you're a good, responsible investor, you always know you need to get more signs than just one in order for you to make any kind of option decision. So as it stands, the price of SPY is right here at $560. Now, if you were to follow this white line right here, you could see that at the 560 mark gives a perfect support level for SPY. So let's say SPY were to make a move from this support level right here, it could do two things. Let's say it decides to continue going down, because no one knows whether it's going to continue going down or it's going to be going up. However, I'm going to show you both scenarios and how they might work out. So let's say SPY decides to go down some more. Well, the next level of support is going to be right here, and that represents the $540 mark. So from 560 to 540, that represents a 20-point drop. Now, let's just say the market decides to change its mind. Instead of going down, it moves from the 560 and it goes up. Now, it did hit a high of around 611, but let's just say it goes back up to $600. And I guarantee you, SPY will hit $600 again. As to when that's going to happen, I do not know. So let's say SPY does go back up to $600. Now the move between 560 to 600 is now a 40-point move. So if you were to use this right now, you're going to get a 2-to-1 with the better odds to the upside. So that's one clear indication that SPY is a good level if we wanted to make a move in order to do some options with it. Now, we're going to go ahead now. We're going to go back to SPY. But even further, I'm going to show you how to get further confirmation whether we should do options on SPY or not. Now, okay, so here we are on stockcharts.com. This is a free resource I use in order to just show the graph. It just looks way better on this website. Now, as you can see to the top here, we have SPY. Now, what I want to bring to your attention is another indicator that I use before making an option decision. And that indicator is the RSI, as you can see to the bottom left here, or better known as the Relative Strength Index. Now, the RSI is what's known as a momentum indicator. Now, this is what I really want you to see. Look at how beautiful this looks right here. Now, for those of you who have no idea what I'm talking about, let me break it down for you really, really simple. The RSI indicator is a momentum indicator that goes from 0 to 100. What we measure most of the time is the movement from 30 to 70. With anything going past 70 is in the overbought territory, and everything going closer to the 30 mark is in oversold territory. The reason why I said this is beautiful is because SPY, as you can see here, is close to the oversold territory. So in my eyes, that's just beautiful. Now let's go ahead and get back and start our getting dirty with options. So now that we use the Robinhood chart and we use the RSI, now we're going to go ahead and decide what options we're going to choose and how we're going to continue making money from this in order for us to get 100% gains in 1 year. So let's go ahead to trade SPY options in order for us to open up the option chain. Now, here we are on the option chain, and the PMCC consists of two smaller option strategy. The first of the option strategy is going to be known as a LEAPS option. A LEAPS option is an acronym for long-term equity anticipation securities. If you guys want a detailed video about how LEAPS work, when to buy, how to make profit, then I do have a video. Go ahead and check out the video right before this one. So let's go ahead to buy. We're going to go to call. Now we're going to go ahead and choose our expiration date. In order for a LEAPS option to be the most effective, it's highly advisable that you go out a year or further. That being said, we're going to go ahead and use the March 20th, 2026, which gives us 373 days to expiration. Let's go ahead and choose that. Now, once again, in order for this option strategy to work the best in your favor, it's highly advisable that you choose your strike price below the current share price. As you can see, the share price is 559. We're just going to round it up to 560. Now, remember, I just showed you the 540 price. Well, it so happened that we have that right here. So what we're going to be doing is that we're going to be going ahead and we're going to be choosing the 540 strike price in order for us to pick up this LEAPS option. Now, with the 540 strike price, we're going to have a 0.69 delta. Now, you can see to the top here, delta. When doing LEAPS option, delta is of important significance, and I will demonstrate that as we go along. Right here, the delta is 0.69, so the delta tells you any movement in this share price of $1 upwards or downwards is going to create a movement in the entire option value right here by $69, either up or down. Now, the reason why it's $69 is that we're dealing with option contracts, and each option contract is multiplied by 100 shares. So if you multiply 0.69 by 100, you're going to get 69. Now, that's just one part of the delta. I'm going to show you once again another reason why you need to pay close attention to the delta. So let's go ahead and we're going to pick up this LEAPS right here. Now, because we're going to be buying an option strategy, that means we're going to have to pay. The amount we're going to have to pay is going to be 64.99. So as you can see to the top here, a long call or a LEAPS option. Let's go ahead, hit continue. So once we go ahead, we're going to pay this amount here, and then this LEAPS option is going to be in our portfolio. Now, what the LEAPS option actually does is that it gives you the ability to control 100 shares of the stock. Not own 100 shares, but control 100 shares of the stock. Now, the reason why anyone would pick up a LEAPS option is because if someone has a very small portfolio or someone is not able to buy 100 shares of the stock outright, then a LEAPS option might be a way to go. So the share price, once again, is $560. If you were to buy 100 shares right now, in order to own 100 shares, this would cost you $56,000. However, by using this little hack, the LEAPS option, you could able to control 100 shares for a lot less. In this case, it's going to cost you around $6,500. Now, I did mention the importance of the delta whenever dealing with LEAPS option. Here's another good use for the delta. Because the delta right here is 0.69, this LEAPS option is going to be a representation of you owning 69 shares of the stock. Not that you own 69 shares, it's a representation that you own 69 shares. Okay, so now that we were able to pick up a LEAPS option, now we're going to go ahead. I'm going to show you how to use this to make consistent income and make 100% profit within a year. So remember the strike date of March 20th, which gives us a year out. We're just going to round it off once again in order to make the math simple. So let's go ahead now and we're going to do our secondary strategy to complete the PMCC or poor man's covered call. Now for that, we're going to go ahead to sell. We're going to go to call, and now we're going to choose our expiration date. Now for this secondary strategy, it's better if you choose the expiration date a lot closer out. Now this is SPY, the Spider ETF. Now it does offer the daily expiration date, but I would not advise anyone to do that. If I were doing this trade right now, the minimum I would do on the Spider ETF LEAPS option is weekly options. So that being said, I'm going to go with March 21st, which gives me around 9 So let's go ahead and select that. Now we're going to go ahead and choose our strike price. Now the strike price I'm going to be going with is going to be the 582 strike price right here. Now with the 582 strike price right here, I'm going to have an extremely high chance of profitability, which is going to be 91%. Because I have a 92% chance of profitability, that means I only have about an 8% chance that this trade goes against me. Now, with my 582 strike price and my 92% chance of profitability, now I'm going to start receiving what's called option premium. Option premium I'm going to be receiving is going to be 0.73. The reason why it's option premium is because now we're going to be selling. So whenever you sell, you gain value or you gain some kind of reward. That reward is going to be 0.73, and in real terms, it's going to be $73. Now, this is where the fun starts. So this is how this leaps option can work. So if you decide and you want to get into leaps option, then I would highly suggest that you stick to ETFs. You could do the Spider ETF, the Russell 2000, which is IWM, or the Triple Q, which is QQQ. The reason for that is that these ETFs are more stable and it takes out the thought of you going and choose individual stocks. So back to the fun at hand. Every single week, I could now go ahead and do this option strategy and just keep generating $73, which is going to be held in my portfolio, and that's going to be used to help build my portfolio. Now, the reason why I could make $73 every single week is because, remember, we picked up that leaps option. Now, that leaps option is going to be acting as collateral in our portfolio in order to do this. Now, let's say, for instance, right, come expiration date right here, and then the share price right here happened to hit the 582 strike price. Now, remember, the 582 strike price is extremely high, and I don't think it's easy for the price to get there, but this is the stock market. Stuff happens, we don't know. So let's say that happens, then what's going to happen now is now we're going to lose our leaps option because that's what's going to be called assigned. Now, the fact that we lose our leaps option is not such a bad thing, and I'm going to go ahead and show you why right now. So at the time we purchased the leaps, if you remember, the share price was trading at 560. If at time of assignment, the share price goes above the strike price we chose, which is 580, now we get what I like to call on this channel investment gains. Our investment gains is going to be the difference between 582 minus 560, which is going to be equal to $22. Once again, always remember, we're dealing with option contracts here. So that $22, we're going to multiply by 100 shares and we're going to get $2,200. Now, that is not all your investment gains. Remember, I did bring to your attention how important the delta is. So once again, we're going to use the delta. So now we're going to take the $2,200 and we're going to multiply that by the delta, because remember, the delta of 0.69 mimics you owning 79 shares of the stock. So multiply 2,200 by 0.69 or 69%. That's going to give you a total investment gains of $1,518. So let's say you continue doing this strategy every single week without being assigned, and you're able to generate around $73 every single week for a year. So now you're going to multiply your 73 by 52 weeks, and that should give you a total of 3,796. So now we're going to go through a hypothetical situation. You're going to take the amount of money you make for an entire year, which is 3,796, and then you're going to add your gains you got for the entire year, which is going to be 1,518. Now, it does not work out this perfectly every single time. Your new total is going to be $5,314 in just 1 year, which almost gives you a 90% increase in just one option strategy and one stock. This is the power of the PMCC, or the poor man's covered call. By using this option strategy, it gives you certain leverages that you could not only wait for your stock appreciation, while you're waiting for the share price to go up, you could be making consistent return that helps to grow your option portfolio. Now, if you guys have any question about the LEAPS option strategy, the PMCC option strategy, or the secondary strategy that makes up the PMCC strategy, which is the covered call option strategy, then feel free to leave me a comment below. Now, here's the summary for you. The PMCC, in my opinion, is one of the most powerful option strategies out there. Not only is it a powerful option strategy, it can be used even if you're trading with a small account. The fact that you cannot afford 100 shares of a stock, you could use this Leaps hack in order to control 100 shares, and then you could go ahead and sell covered calls in order to generate consistent income. Just a keynote, whenever dealing with Leaps option, always pay very close attention to your delta. The delta is going to tell you what's going to make you money or lose you some money. Now, for you guys that made it to the end of the video, I want to let you guys know this. The PMCC or no option strategy ever works out 100% of the time. So always make sure you do your own due diligence before investing, and always make sure you have an exit strategy before entering any option contract. That being said, go ahead, like the video, subscribe to the channel. And if there's anyone out there trying to use one single option strategy in order to make consistent income to supplement their regular 9 to 5, then feel free to share the video with them. Let's help as many as we can. And until the next video, please keep using the PMCC.